Yeah, so as we transition from this optimized to the they call cost plus in pricing, or some articles they call just plus pricing. Okay, plus means we are plus something on the cost. Okay, cost plus something like plus the markup will be the pricing. And okay, I think that's kind of similar to the prior slides. Okay, but I'm just the thing they call like integrated approach, or in terms of the cost and benefits. Okay, so some pricing strategies are the combination of both. Okay, like because if you can do the maximize the profits and with valid data, so you can really end up accurate and more precise pricings. And but you can also use the cost-based pricing, like get some simplified model and use the economic model to validate this simple model. So that's probably they say this combination of the two probably can give the best pricing strategy to the managers. But now let's see the cost plus pricing. And some I posted 2 additional reading papers, like articles is actually online reading in the under Connect. And one is a simple, so like is a more straightforward comparison about the plus pricing and the target pricing, which we talk about next week. And in that article, they even didn't put the cost in the term. Okay, they just call plus pricing. And this plus presumably is the cost plus, right? So plus what? Plus on the cost. So in this modeling, most people can, I think every people, especially with business background, you can understand we are deciding the price based upon the cost plus a markup percentage. I don't really think some people will probably call profit percentage. We didn't really call that's kind of from traditionally they call markup, right? So how much you charge the price above, right? So like I need to cover my cost first, definitely. That's break even, right? Then I want a like the profit level or markup percentage, because I still have after you cover all of your costs, I need to make profits or make investment returns. Like I'm requiring a 20% investment return, or like 10,000 profits, but that's your target profits. So I'm adding a markup percentage above the cost as my profit, or as the company's profit. So this is a general idea. But when you work on the details, normally you can come in with like 2 questions. How much is a reasonable markup? Like mostly we use a percentage. And how you define the cost, because in prior chapters, we have different layers of the cost, especially when we analyze the cost behavior. We have variable cost, we have variable production cost, variable selling and admin cost, right? Then we have fixed cost, fixed production, and then fixed marketing and admin. So depending on your like the cost layers, you need to consider different markup percentage. The lower cost you consider. So for example, when I'm trying to think about my cost, I'm thinking about covering the variable cost only. Variable cost only. Like variable production, then variable sales and marketing. Then your markup should be higher because you haven't included the fixed expense in your cost layer yet, right? So before you make any profits, you still need to cover your fixed expense. So that's really depending on the manager's definition or idea about the cost layer. The last item you include in the cost layer, you need to mark up a percentage much higher, right? Then because you leave room for profits and cover other expenses. Right? Then you may have another question. Why we don't have a consistent cost layer to consider? Like I'm saying, all of my absorption costing, okay, means all of my variable, fixed, production, and period cost. That's fine. So we call full pricing model. So if you already include everything under your cost, then this markup is primarily the profits you are looking for, right? So like this, I'm just making a small case. Okay, for example, the full cost to make a office chair, right? So like this computer chair or some like computer chairs, $100, including every item to make and market and deliver the product. So 100. Then for me, I need to at least charge 100, right, to make break even. And then this markup percentage is you really are looking for your profit. So for example, I can ask I'm considering a 20% of the cost becomes my profit, right, or markup. And then you use the 20% for 100, then we can easily go to the price. So 100 plus 20 is $120 per chair, right, per computer chair. That's something if you already have all of the cost items under your cost structure, right? That again, how I can know is 100. Our chapter 2, 3, 4, right? That's the chapter we learn how to make the cost reports for the total cost and the unit cost. And then, but if I change the question slightly, so why do my pricing is, and here I'm considering my cost layer is only my, so for example, variable cost.
I'm sorry, I couldn't hear you.
Maybe now can you hear me now?
Yes.
Okay, yeah, maybe the web, like the internet. So variable cost. So imagine if like when I'm looking for the cost of this computer chair, I'm only looking for the variable cost, like direct material, direct labor, variable overhead, and the variable selling and admin expenses. I still have a total amount of fixed expense not including here. Then will you make up the price? So can I still use this 20% markup rate? Like, like this? So does this make common sense? If I only use 20% as my markup expectation. So what I'm missing here? You didn't consider the fixed expense. So if you still use the 20%, definitely I think you will lose money. And because this only give you $12. So $12 plus 60. Okay, let me finish the calculation. So if you really continue to this, you will only get a $72 for pricing. And given you can see, your true full cost is 100. So the pricing is already lower than your true cost, right? So you are really pricing your product in a disadvantage to lose money from the beginning. I'm not really saying, so you say, who is going to be, right, so stupid to, but I'm just giving a extreme case. Oh, telling you, depending on the cost definition, the markup percentage you need to adjust. Okay, depending on like the layers. Now let's continue to use this. So I probably will do so when I do look for this 60 as my cost layer, while adding the markup, I will really ask a much higher. So for example, I'm guessing a 40. Maybe let me, for example, 50%. 50 is too small still. Maybe 100. I think this is more. Yeah, right. This is make more sense, right? Because you say 5 times the markup in this case will be 5 times higher than the markup when I use for like this the full price, because I'm considering my cost low. I still need to make up this 100 will need to cover your fixed expense, even we are not adding the fixed expense here, plus your desired profit. Now you can see that's giving me a equivalent 60 plus 60, kind of going to the 120 level, right? And this 120 is comparable to the first option when we use the full cost and a 20% markup. No, so I'm making this incidentally like the equal, right? But again, so in the reality, you can adjust it maybe to 110 or 95. It will give you some, but the whole point for this plus pricing is this plus you have flexibility to determine depending on the cost level, right? So that's like why the book give you 4 different markup formulas. So you may be wondering, and when for one situation, the manager or your company may consistently using one of them. Okay, but when you use one of them, be especially aware of the cost layer you are doing there, because the markup rate needed to be adjusted, okay, to reflect your cost selection. And now let me jump to this one. Okay, you can see, and quickly the book also has it. So what are the 4 cost selections when you choose the markup rate? The bottom one is your variable manufacture cost only. You can see even more strictly than the variable cost I was using, because they are only using the variable manufacture cost or variable product cost. In this case, you got the highest markup rate, the green one, because you need this high, very high rate to cover all of the other cost expense we didn't put in the cost layer, like your variable selling and element, then fix the manufacture, and then fix the selling and element expense. So we have 250 per unit, 50 and 100. So this markup rate should give you adequate room to cover all of the rest of cost and give you some profits. Oh, so that's like 925. Then second, this is the variable costing as I used. So variable cost total. So we add the variable selling and element, right? So you increase your cost layer, but drop the markup rate slightly, not a huge difference, because we have no fixed expense. We still have $350,000, $350 fixed expense didn't cover, right? So dropped about 10% markup, but still high, and we reach the same pricing. Again, the book is using the same pricing, so I can dissect the difference on the cost and the markup rate. And the third choice, we use this one they call full absorption manufacture cost. And this is kind of go to the financial accounting. We are not differentiating the variable and the fixed, we are differentiating the product cost and the period cost. See, 650 is our full product cost. And now you can see the markup rate is significantly reduced from the variable costing approach, right? So only like 42% of this full absorption cost. Okay, we are reaching the same sales price. And now coming up to the bottom, this is really the full pricing model. Full pricing, full plus pricing. Okay, I'm using, that's like the 100 I use for the computer chair case. So $800 full pricing for the product. And this 15, like around 16% is like my targeted profit. Okay, the lowest among all of the 4 cost models. And we are reaching the same price. And in reality, again, they are talking about you are probably based upon your industry or your preference, you can use one of them, but consistently, right? And you can adjust this markup period by period by looking for your history, and you can use it for prediction. Okay, for prediction of deciding the future prices, right? So if the market is strong, our products is popular, I can slightly adjust the markup rate high, right? Or if you have, we have this high inflation, I have to increase the markup rate, right, to counter the inflation impact, right? So that's like the things. Again, the cost item, like the cost data may change over time, or in the future, from the past. So that's all adjustable. Okay, we are just giving the models you can follow. And then discuss the advantage and disadvantage using the variable and absorption. That's kind of back into some topic early. So variable costing or absorption costing report, because for external, if you can recall, we use absorption costing for external users, okay, or external reports, like the traditional income statement. Right? Traditional income statement, we focus on the difference between product cost and the period cost. We have gross margin in the beginning, right, in the middle. So that's we compare in both in the beginning chapters and also in the CVP parts. Okay. So absorption costing mostly for external users. So the price covers all cost and perceived as equitable, and we can compare our pricing with competitors. And here they put it, absorption costing used for external. The most disadvantage is the full absorption costing obscures the distinction between variable and fixed cost, right? Because when you put like the 650 or the full pricing, so we are kind of mixing all of the costs together. It's not easy for us to analyze. So when the volume or when especially when the volume change, how the cost item will react or change. So it's kind of like hard to predict the cost change when the market demand or maybe the market situation change. Okay, that's like so for prediction become hard. If you use variable costing, the advantage is we have clear separation of the variable and the fixed cost, like the operating leverage or operating structure. So more useful for internal managers to make special decisions like the one we used in chapter 14. Special pricings, right? So drop or keep a product. Equipment replacement, auto sourcing, so make or buy options, right? So more useful for short time, quick decisions. And disadvantage is you may ignore or underestimate the fixed cost in your pricing decisions. Like when I accept a special order, I may underestimate the equipment usage was for this special order. So when I charge the price, I only charge the variable cost, but actually I use the equipment, right? So you may undercharge your customers and make the equipment like wearing out and didn't really got depreciated adequately by the volume of productions. So what you can find out is the equipment is really wear out before the full capacity, before you reach the full capacity, right? So you think you still can use the equipment for another year, but just broken. But you haven't really recouped all of the depreciation expenses yet. Okay, that may happen. So, you didn't got the full fixed cost covered. Okay, that's something. Be careful when using the variable costing. And then I think I will just wrap up using this slide, because for other details like the book example for using this, let's see that the book example, they summarize how to determine like this. So how I can got this non-$25 sales price. How I determine the markup percentage depending on my cost choice. Be careful, my cost choice. Because if I using like this is only the variable manufacturer cost, right? The lowest cost layer, then I have to use in the markup, which is the highest percentage. So you may wondering, why you use a different cost layer, you end up with the same sales price, non-25. Because the non-25 is determined by your targeted profit or your expected investment return. Okay, that's again your target return or targeted profit. So you set up this price kind of like as a general goal, and then start to think about the markup rate. And use this rate, you can adjust this for the future. Okay, like this one, and the targeted profit is probably your prediction, right? Or your goal. And then you use the goal to determine the markup rate. And then they summarize for different layer, again, different layer of your cost choice, you will end up with different markup rate. Right? If I increase my the cost increase my cost, so adding the variable, I think this one is adding the variable selling and element, right? So variable cost, all of the variable costs are considered, will reduce the markup rate than the lowest cost level by around 10%. Oh, sorry, 15% something. Okay. From 131, you drop down to 106%. Now, if we add the variable selling and element, I like this one. So they have a generalized formula, not in the original slide, but in the book. Right? So that's the idea. Okay, the less cost item you include, the higher markup rate will require. So the more cost you include, the lower markup rate you should get in the cost pricing for the 4 different levels. And the book, they have probably most of the calculations you can check for more details. So we already have 2 of these. And if you change your cost layer, and this markup rate will be adjusted accordingly. Then finally getting on to the real world application, I add this slide by myself, and that's coming from one of the additional reading articles I posted on Blackboard. So in real world, which type of companies mostly use this plus pricing strategy rather than the target costing? Interesting, you see most of the retail, not the manufacturers, retail companies using the cost plus pricing means they add a markup percentage on their purchasing price or the cost from the vendors, right? Groceries, department stores, clothing, right? For example, all of your grocery items, milk, egg, veggies, all of the meats, they add, again, depending on your cost layer, okay, a certain acceptable or industry general percentage to the vendor pricing as the sales price. And what's the benefit? Okay, why in this industry they use the cost plus pricing? And do you think this makes sense? So by this pricing policy, they can build trust and earn more business. Because if you, for example, you already established a close link between the customer and some of your inventory items. For example, I normally sell the lowest price milk or specialized bread or egg, right? And then the customers normally will come to you for milk purchase or bread. And in the meantime, they will buy other stuff from your store also, rather than only looking for the lower pricing or specialized items. I think that makes common sense for our shopping experience, right? That's like you can see they have the weekly deals, right, from all of the retailers on weekly basis. They are competing on, they offer some specialized or sale price or coupon, right? Digital coupon or whatever the promotion for, they can do the rotation, right? So like rotating the items. So when customers are attracted to the store for the special price the items, they will do shopping for other general items as well. And they may pay your regular pricing or even higher pricing than other competitors. That's kind of my take on this. Right, so it's not, because again, I think about the retail is they don't really make the products by themselves. They are not the manufacturer, right? They are only like kind of the intermediary. They bought it from vendors and resell to customers, and they add a percentage at their own profit or between the cost and selling price. But I think for most of the retail stores, their overall margin is kind of thin. I think I've been checking for like even like Walmart. I remember kind of like I didn't really follow up with the after COVID era, but previously like for Walmart, their the profit margin is only like a 5% or 6%, very low. So every $100, they are only making $5 as a profit. And even for dealers, they used to have 3% margin, and during the COVID, they already on big loss. So their profit margin is negative. Even like Ross, like Kohl's, right? So, discount department stores and even Dollar Tree, right? Their margin has been really on declining. I didn't really observe again, do the recent research, but very competitive. in this general market, right? So you may think about the luxury, the Saks Fifth Avenue or Neiman Marcus or even the Nordstrom. They are not really doing much better. They are not, I'm saying, okay, like that even may be doing poorly than, because the consumer market is not very good in general, right? But anyway, so, and there are two articles. There is the other one, they talk about a lot of the real world pricing strategies of different companies, which I think is very interesting. And they have Apple, Tesla, Rolex, okay, and penetration, Amazon, okay, Kindle, Xiaomi which is a Chinese cell phone, kind of the number one, like not Huawei, okay, another popular Chinese phone brand. They really have market now in kind of the Southeast Asia countries like India, Philippines, Indonesia. Their model of the phone is more popular than Apple because they are I'm not really saying way cheaper, but it's more economic, it's more affordable, right? By the kind of like less lower income people. And so do check those out. Okay, Uber, airline companies, or Amazon, they are successful stories regarding their pricing strategies. Okay, movie theaters, software pricing. Okay, do check those out for. So this week again we focus on I only have one homework, but two separated smart book for chapter 15. Okay, be careful so you wouldn't miss anything. Okay, as the last learning module. So you can focus on and do study on Thursday by yourself. But email me if you have any questions. And next week, we'll wrap up the target costing as the true last topic of the class. And so then we can leave about like 1 week for review, like a study before we take the second exam and wrap up the whole course. Okay, I think, yeah, it's right on time.